After months of deliberation, the U.S. debt limit has been suspended, and we thankfully have avoided the potential for a national default. But what does a suspension versus a raise look like? And what potential risks to the market still exist? Hi, I'm Liz Laprade, Senior Investment Research Analyst, with today's episode of the Harbor Lookout. It's been a while, but I am back and I am here to talk about the debt limit. Back in January, the U.S. Treasury Department ran up against the debt limit, which is a hard cap on how much the government can borrow. Unfortunately, it took right up until the final hour for the government to reach an agreement to suspend the limit until January 2025. So what does a suspension versus a raise of the limit really look like? Well, in prior limit standoffs, we've seen the dollar amount of the cap get pushed up, enforcing a higher new limit on U.S. debt. This time around, they are just suspending it, meaning the government can borrow as much as it wants until January 2025, at which point we can probably assume a new political battle will ensue over the limit, and we will most likely experience market stress similar to what we've seen this time around. So for me, suspension feels a little bit like a Band-Aid, but what now, right? Are there any other risks out there in regards to the debt limit? Well, the deal definitely helped calm markets down, and I hope we can assume that volatility will continue to die down, but there are still some factors to consider. For one, leading up to the X date, which was the date the Treasury would most likely have defaulted on its debt if we hadn't reached a deal, interest rates jumped as investors required a higher premium for taking on that risk of default. While we can expect those rates to come down a little, it still means that the Treasury will be on the hook for making those higher interest rate payments on any bonds issued over the last month or so, because they are all locked in for various timeframes. This results in higher costs to the government, which could hypothetically at some point translate to costs to the consumer through, say, taxes or spending cuts. Additionally, investors are expecting the Treasury to flood the markets in the coming weeks with new bond issuances. And there's a worry that this could suck liquidity out of the markets as investors jump, at these higher yields. This could also have a negative effect on the already struggling banking system. Ideally, though, and most likely, these funds might get pulled from money markets, which have seen a huge run up, and that ideally would lessen the market impact. In summary, the default crisis was averted, and the government decided to basically kick the can down the road until January 2025. Unfortunately, though, the months-long debate did not go without cost to investors in the form of higher interest rate payments and worry about the effects of a tsunami of new bond issuances. Overall, though, I'll take dealing with these potential ramifications to these factors over the U.S. having actually defaulted on its debt. And that is it for me today. I will talk to you all soon.